Hi to all of those who have joined us to this Quo Vadis Revisited webinar for 45 minutes. We will give a few more minutes, as we always do, to people who will join us a little bit later, but not too much, so we'll start in a few minutes. Just a bit of logistics. There is a chat function. You can ask us questions. We will try to get to those questions at the end of the session rather than during the session. But if you do not get an answer to your question, maybe because we run out of time or there are too many questions, then we will please drop us an email either to Harry Nutzels or to myself, and we will endeavor to get back to you with the answer that you seek. In the meantime, let's give another 2-3 minutes for people to join us. So, Harry, if you want to type out how many people have joined so that I can know when we have sufficient quorum to start. Oh, actually, it's okay. I've got it. I've located on this the button. We've got 89 people having joined us. So let's give it another minute or so. It's been a very interesting year for the markets. 2022. It always is. TCS set itself off in 2012, and it has pretty much every single year since 2012 has been interesting in one way or another. So 2022 was absolutely no exception. Although interestingly enough, I mean, 2022 was interesting for a lot of exogenous reasons. A lot of things happened in 2022 for securitization market, but it's clear that a lot of them were displaying the fact that securitization is part of the capital markets, and capital markets are part of financial markets, and financial markets are part of the wider economy. So, inflation and the war in Ukraine had more impact on securitization and all the other asset classes, be it corporate bonds or sovereign bonds, than endogenous securitization issues.
One thing, Ian, just logistics, the notes are going to be in the header section if people want to take the slides later.
Yeah, so the handouts will be available. They'll also be available if you don't get them now. They will be available on our website under our Great Library heading. We very much encourage you to go to our website. You find quite a lot of stuff there, which some of it may be of interest. Okay, so I think we have 108 people. So I think on that basis, we will start the presentation. So the way we've looked at this presentation, it's Quo Vadis Revisited. Where is the securitization market in Europe going? The big picture in terms of the things that influence the securitization market and its future remain the same, and you will see about them here. We've taken the same structure as we did last year. So the issues or the situations that will impact the securitization market are central bank policies, monetary policies. So we'll deal with that first. Then there are the Basel issues. And securitization, of course, is a capital management tool as much as, and maybe more these days, than a funding tool. So, Basel capital requirements are going to be a big important part of how the securitization market in Europe shapes itself. Then we have green. Green is going to be both, as we discussed over many seminars, potentially a great opportunity for securitization that can play a role in mobilizing finance for sustainability, but it can also be a big threat if the securitization regime around green is heavy or unwieldy or frankly impossible to operate. And there's been a lot of things happening in 2022 around this, so that will bring you up to date with where we are now and how we think that will impact the future of securitization. And then, of course, the regulatory aspects, both in terms of securitization regulation itself, and again, we will have had things happening in 2022, and around calibration issues, Solvency II and CRR. And of course, since Brexit and really biting in 2021, we will have to do this analysis both for the UK and for the EU, since they are now effectively separate markets. So first of all, monetary policy. The monetary policy has been blamed for a lot. Certainly, a number of regulators and policymakers seem to think that the lack of growth in securitization market is pretty much entirely to be laid at the feet of the ECB and the Bank of England's monetary policy in, hosing money for free across Europe. We think that's probably not quite as true. Clearly, monetary policy has influenced securitization volumes. It would be crazy to say it hasn't, but not necessarily in the way or as much as some people will have you understand. So first of all, let's deal with the ECB, what's happened in 2022 and how that's going to impact 2023. So originally in the presentation, we took people through the whole suite of ECB monetary intervention toolboxes. We're not going to do that again. You can see it on the handout. And if you want, you can also listen to our original presentation back in at the end of 2021 to get more details. But so what's happening? The two big items here are the asset purchase program, where the ECB will basically purchase securities in the market, and there were 4 of those. They're listed here. Obviously, the fourth one is the one that is actually, interestingly, the fourth one is the asset-backed securities purchase program. As important, I think, to the securitization market, and we'll discuss this, is the covered bond purchase program. That is the penultimate one on this list. So if you look at the outstandings at the end of 2022 compared to the outstandings at the end of 21, it would appear that 2022 actually looked like an increase in the purchase programs. As you can see, in every category except one, securitization, the outstandings at the end of 22 were greater than the outstandings at the end of 21 just. The other thing, of course, which comes very clearly out of this graph, is just how minuscule the asset-backed purchase program was. You can see at the end of 2022, 24 billion outstanding, still held by the ECB as part of their purchases, compared to 302 billion of covered bonds. Obviously, as to no one's surprise, sovereign debt is the biggest purchasing item in the ECB. But nevertheless, let's face it, covered bonds are more than 10 times in outstandings, asset-backed paper of all kinds. And that obviously was true before, remains true today. However, this chart is also slightly unhelpful and slightly misleading, because the reality can be seen much more in these charts, the next 2 charts. Basically, in July 2022, the ECB stopped purchasing, didn't stop purchasing, but stopped net purchases. So from July 2022, as we, again, not surprising considering the QT is now the order of the day, from July 2022, the ECB simply reinvested maturities. So as bonds matured, they took the maturity proceeds and reinvested them. And so you can see there, halfway through 2022, this sort of ever-growing curve just flattened to 0. And this is even more visible here, which are the numbers for the net purchases by program. And you can just see basically halfway through 2022, it falls to 0. And that means, and beyond that, in December of last year, the ECB also indicated that it would stop reinvesting 15 billion a month between March and June of this year. So having only reinvested existing maturities from July onwards, it is now saying it's not even going to do that, and it's going to start reducing its holdings in bonds by not reinvesting 15 billion a month between March and June. It's an effective drop of about 50% in the reinvestment. And it is widely anticipated, subject to events. Who knows what will happen? But it is widely anticipated at this point that after June, this reduction of reinvestments will be maintained or, in fact, accelerate. So what we're basically seeing is that in practice, the ECB bid in the market is reducing. The pandemic emergency purchase program, we talked about it. As I said, we've built this this presentation based on the presentation we gave at the very end of 2021. The pandemic emergency purchase program was supposed to end in March 2022, and that's exactly what happened. So that's now gone, and it's not part of the equation. So that's the purchase programs. What about the TLTRO, which is basically the soft money, very soft money window where banks could basically borrow for very, very, very low rates. So this is a description of what it was. Two things that happened there. So there's still 1.3 trillion outstanding. It's a large amount, but two things have happened. First of all, in October 2022, the ECB unilaterally changed the interest rates on the TLTRO. So I don't know how many of you are lawyers in this audience, but this was a very interesting lesson in the importance, or rather the lack of importance, of documentation and legal relations. Because if you look at the terms of borrowing of the TLTRO, there was absolutely no provision that would have allowed the ECB really to change the interest rate payable on the TLTRO. However, the reality was that when the rates went up as a result of the general rates, not the rates on TLTRO, when the general rates went up as a result of the ECB's fight against inflation that was, of course, rising very, very swiftly, it produced a somewhat unhappy reality for both the ECB and for European taxpayers, which is that banks, instead of repaying the TLTRO, which was fixed, the interest rate on which was fixed at a very, very low level, could start making money for no effort at all by keeping the TLTRO money that they had borrowed from the ECB and then redepositing exactly that money with the ECB, which was now, of course, paying a higher rate of interest on deposits, reflecting the rise in rates to fight inflation, was paying a higher rate in interest on the TLTRO money than the banks had to pay to the ECB for having borrowed this money, thus creating this wonderful arbitrage where banks could simply keep their TLTRO amounts outstanding as long as possible and just make money after the ECB for absolutely zero risk, using ECB money to be placed with the ECB. This was somewhat scandalous if you were a European Union citizen. And so the ECB simply said, yep, we're going to just raise the rate on the TLTRO, notwithstanding the fact that we don't really have the right to do so, but we're going to do it anyway. And since nobody was going to drag, no bank in its sane mind was going to drag its regulator to court in order to argue in front of the entire European citizenship that they wanted to keep making money off the citizens for no risk whatsoever, everybody just swallowed this. And the result of that is now that outstanding TLTRO is more expensive than it certainly was before, and therefore there's very little incentive to keep the TLTRO outstanding. So between scheduled maturities and the less attractive terms of holding this TLTRO money, it is expected that in 2023, there will be quite a lot of redemptions of the almost 1.5 trillion still left under the TLTRO. And so if you look at the reduction of the asset purchase program, the non-reinvestment from March to June and what is assumed to be the further non-reinvestment post-June, so that will slim down the securities held by the ECB, and the expected repayment, either scheduled or prepayments, of the TLTRO, it is expected that over next year, the ECB's balance sheet is going to reduce by about 15%. This would leave the ECB's balance sheet at 50% of the Eurozone's GDP, which is down from its height of 70% of Eurozone GDP. However, if those figures don't mean an awful lot to you, or if it sounds to you like this is a big slimming exercise, you may want to think about the fact that prior to the sovereign crisis in 2011, 2012, the balance sheet of the ECB was between 12 and 15% of the Eurozone GDP. So even after the reduction of 2023, the anticipated reduction of 2023, leaving the balance sheet at 50%, this is still massively larger than it used to be, and it gives you a sense of the magnitude of the ECB's action, I should say, in the markets. So this is still a talk about securitization and securitization market, Quo Vadis. What does that slimming down of the ECB's balance sheet mean? Well, first of all, the TLTRO funding is going to have to be replaced. We're assuming the banks did something with that. And that could be helpful because the banks will have to return to traditional funding sources to replace that TLTRO. Now, I wouldn't be too optimistic about the size of the impact. So I think I can be optimistic about the fact that it will have an impact. The banks will certainly turn to securitization to replace some of the TLTRO. But we also need to bear in mind that over the last 5, 6, 7 years, the extraordinary success of the covered bond market as a financing tool for banks, and one has to assume that all other things being equal, it is likely that a lot of that refinance of TLTRO money will happen through covered bonds. But some of it will happen through securitization. And certainly we anticipate, speaking to people in the market, we anticipate that a number of banks will want to do, even if they do covered bonds to replace a large bulk of that TLTRO, they will want to do some securitization because nobody wants all their eggs in the same basket. At least nobody thinking this long term will want all their eggs in the same basket. So some of that will we think find itself through true sale securitization and funding forms of securitization. How much, interestingly enough, may have to do with the impact of the shrinking of the asset purchase programs. So on the one hand, the fact that the ECB bid is going to be much smaller or even disappear over time from asset-backed issuance could put pressures on prices to increase the prices of securitization and make it less attractive for, decrease the price of the bond, increase the coupon, making it less attractive for originators. But another intriguing potential effect is that you will remember, I'll go back to the slide. You'll remember this slide, which showed just how much more covered bonds were purchased than securitizations. And by the way, this is not just in absolute terms, but even in relative terms, more of the covered bonds were purchased by the ECB than in any given issuance asset-backed. So the result is that the impact of the withdrawal of the ECB bid on covered bonds is likely to be much more substantial in terms of pricing than the withdrawal of the ECB bid in securitization. And so one of the possible consequences of the slimming down of the asset purchase program, the reduction of the size of the ECB's holdings and their withdrawal from the bidding process completely or partially for both covered bonds and asset-backed could be that the prices of covered bonds could fall. In other words, the coupon on covered bonds is going to rise, and we've seen some evidence of that at the beginning of this year, and therefore since the impact is likely to be less noticeable in asset-backed, it is entirely possible that one of the results of the withdrawal of the ECB from net purchases in the asset purchase program generally will be a shrinkage of the gap between the spread on covered bonds and the spread on securitizations, making securitizations more attractive comparatively relative to covered bonds. So difficult to say. TLTRO repayments will drive some true sale securitization. How much true sale securitization depends in part on whether or not the lack of ECB bid via the purchase program impacts more heavily, and how much more heavily, covered bonds than it does asset-backed securities, making potentially asset-backed securities more relatively attractive than covered bonds. I'm not saying that the spreads on asset-backed securities are going to be below those of covered bonds, but this surplus as for asset-backed may be less large. So that's where we are, and the timetable just reflects all of these things. Bank of England, in a way, much smaller story. The Bank of England pulled back from its support faster, earlier than the ECB. So there were three programs: the FLS, the TFS, and the TFSME. Now I'm going to go through it. The FLS is gone. The last repayment was in September 2021. This is the last year's slide, but you can basically see that happened. The TFS, equally, the last repayment under the TFS was made in February of 2022. So that's just gone. It's no longer there. And the TFSME is still outstanding. There's about 182 billion outstanding under that lending. This is the equivalent of TLTRO for the Bank of England. But basically, there's no new uptakes. If you look at how much is being repaid versus how much is outstanding and how much is being borrowed, it's basically being paid off. So the impact of these tools ended earlier in the UK than they did in the ECB, where they're still being felt. And the impact, therefore, on the securitization market was really a 2022 story. If anything, there may be an acceleration in 2023, but the Bank of England's lending facilities are no longer moving the dial and haven't for a while now in UK issuance. Asset purchase facility, of course, the Bank of England has one, but it never bought securitizations. So as of this month, the Bank of England still held 828 billion in gilts, 9.5 billion in corporate bonds, and absolutely nothing in asset-backed. So that was never part of the shape of the securitization market, the volumes of the securitization market. Now, of course, these holdings, particularly the 828 billion in gilts, were massively inflated as a result of the debacle over the mini budget. And there's a note here because it's an important piece of evidence when it comes to securitization. We, the securitization community, have been told by some people, particularly in the regulatory community, that securitization was not liquid. It was a liquid product, and as an illiquid product, it couldn't really be part of LCRs, or very, very limited amount in LCRs, and there were all these other issues. Solvency II for the European Union, of course, still applicable in the UK after Brexit. Solvency II, the high capital was due to the fact that, again, it was argued that securitization was illiquid. Well, here we are. During the mini budget debacle, we got to a point, and that's the point where the Bank of England intervened. We got to a point where there was no bid on the 30-year gilt. There's no bid in the market on the 30-year UK government bond. And yet, at the same time, 4 billion, the same week, 4 billion of securitization traded. Traded without a hitch, traded it without a blowout of the bid offer. I mean, the bid offer increased, but you can imagine as people are dumping securities, there was always going to be an increase, but a perfectly reasonable increase in the bid offer, nothing spectacular. You couldn't sell a UK gilt, but you could sell as much securitization as you wanted. And so therefore, that is something that, we certainly remind people of when we talk to policymakers. Can we please stop saying that securitization is illiquid? The proof that week was quite clear. So that's basically the impact of central bank funding, or the potential impact of central bank funding. Definitely some help for true sale securitization in Europe. How much depends on, as I said, the impact of the reduction of the asset purchase program between covered bonds and securitizations. But also, let's not kid ourselves that all of that TLTRO money is going to find its way into securitization. It won't. A lot of it will find its way in refinancing via covered bonds. Basel. Now, Basel is extremely important. The Basel and the infamous output floors, January 2025, for those of you who've forgotten, is when the output floors start to bite. They will bite over a number of years. It starts at 50%. So the output floors will be at 50% of the standardized number and grows to 72.5% of the standardized number over a number of years. The output floors, by all accounts, will, and just to remind people who don't know what an output floor is, under the final implementation of Basel III, as I said, it starts in January 2025. Whatever your internal model tells you about how much capital you need to allocate against any kind of asset you hold as a bank, that number can never be less than, at the end of the transition period, can never be less than 72.5% of what the standardized model, not your internal model, but the standardized model gives you. And for some asset classes like mortgages, the internal models based on actual data show very, very low levels of capital required, fairly so, because it's not a risky asset. The output floors will impact that quite substantially. And the output floors will also, of course, impact securitizations held by banks in their treasury. So what that means in terms of securitization is that capital, because as I said, the output floors are expected to increase the requirements for capital for European banks unevenly, but nevertheless in aggregate quite substantially. So managing capital becomes really, really important. And we have certainly, speaking to people in the market, speaking to banks in the market in particular, originators of securitization, we've noticed a much heightened focus on capital in the last 12 to 18 months. And so in Basel, nothing has changed. I'm going to just skip through the slides again. You can read them. These are the slides we produced last year to explain how all of this worked. Nothing's changed. The deadlines are still exactly the same on the output floor. So you see here, this is what I explained in a very small, reduced fashion, but basically this is how the output floors work. And they come into force in January 2025. There's a transition period. All of that remains exactly the same. So the pressure on banks to figure out ways of, and this is by the way, the UK. The UK started implementing the output floors this year. If anything, it's even more striking in the UK, more acute an issue in the UK. And none of this has changed. And so looking at 2023, we expect to see a continuation driven by these concerns on capital by the implementation of Basel and the output floors. We expect to continue seeing a great focus on capital, and that means a lot of synthetic transactions, but also potentially true sale, full capital stack transactions happening. So we think the growth in synthetics will continue, if not accelerate, and we expect the final implementation of Basel III in the European Union in January 2025 to accelerate also the number of true sale full stack securitizations. It's not going to be a tsunami, but that should, again, all things being equal, increase the market in 2023 in terms of issuance. So I said there were 5 big topics which would impact on the future of securitization. How green will my securitization be? So again, we've reproduced the slides from last year that explained all of these things, the impact of green. It's a threat and an opportunity, and we will reiterate this for those of you who weren't at the webinar last year, or those who may have even forgotten what we said, if it wasn't so memorable that you will remember it a year and a half later. Basically, it's an opportunity because securitization is going to be needed to fund the green transition in Europe. The numbers required to fund that transition are ginormous, and if securitization is not part of the mix, it's going to make it that much harder for the sustainability transformation to take place. It's also a threat because we know that a lot of money will go into this green transformation. A lot of investors want to do it. A lot of banks, which are going to have to report the green asset ratio, will want to have green on their balance sheet. And it's a threat, therefore, for securitization, because if the rules describing and structuring green securitization, the regulations describing and structuring green securitizations were heavy and even potentially unworkable, it would be almost impossible to do green securitization, or at worst, even impossible to do green securitization. And therefore, all this green money would simply turn its back on securitization. So there's an opportunity and a threat there. How have things evolved during the year? Actually, broadly, they've gone in the right direction, which is novelty for those of us in the securitization community who are used to regulations going in the wrong direction. So here we've got 2 columns. The first column on the left sets out what we wrote in the slide last year, and the column on the right sets out how things have evolved in 2022, and therefore what we can expect in 2023 and beyond. So the big issue was assets versus proceeds. What does that mean? That means, is the definition, the regulatory definition of securitization, is it assets that are green? We are securitizing green assets. Or is a green securitization a securitization like all other capital markets instruments, be it corporate bond, bank bond, whatever? Is it a securitization where the proceeds, the money raised, is used for green projects? The argument that it's green assets may be kind of superficially quite attractive and seem right. But the problem is that we're trying to fund a transition here to an economy with green assets. And until that transition is taking place, there are virtually no green assets available to do securitizations with. So a definition of green securitization that required green assets was both discriminatory, because it would be the only instrument which didn't proceed, no pun intended, by the use of proceeds, but also would make the contribution of securitization to the greening of the economy nearly impossible, because there were no green assets to securitize. The good news is that through various amendments to the European Union Green Bond Standard, it does now look like the idea that green securitization is a securitization where the proceeds are used for green purposes is winning out. The EBA in its report came out in favor of that approach. The Commission has also now kind of put its weight behind that approach. And the EU Green Bond Standard, the legislation, is in trilogue, which means it's being discussed now between the European Parliament, the European Council, and the Commission. And that does look like it's going to come out with green proceeds rather than green assets. So that's good. The other risk was that a bespoke and idiosyncratically onerous disclosure requirement was going to be imposed on securitization, i.e. we're going to have yet again impossible to meet rules around disclosure. Again, that seems to be going well. It looks like in the latest versions of the text, the EU Green Bond Standard regulation, that there will be additional disclosures required of securitization. but they don't look viciously onerous. And so we think that's again going in the right direction. And finally, the other risk was that somebody would come up with a completely different regime for securitization, completely, utterly different regime for securitization, making it pretty much impossible for investors trained to identify and buy green bonds outside of the securitization space to buy green securitizations, because they would have to apply completely different rules. Both the EBA and the Commission have rejected this, and none of this seems to be finding its way in the European Green Bond Standard negotiations. So I think over 2022, things have gone very much the right way. We didn't get everything we wanted as a securitization community, but we seem to be getting most of what we want, which is a green proceeds rather than green assets, without massively onerous disclosure requirements, and certainly without a separate regime for securitization. So looking forward, if all goes well, we will get, this is, by the way, these slides just describe to you what I've just talked about, what is the European Green Bond Standard, and so on. We do look like we are going in the right direction. And some of us are always, worried about a last minute transformation, but nevertheless quietly confident, maybe not so quietly since I've just announced this to 147 people, but quietly confident that we will land in a place that will make green securitization possible. But when this will come out, we don't know, because the EU Green Bond Standard seems to be stuck amongst titanic battles between various players, particularly between the Parliament and the Council, and even within the Council, over other issues, not securitization. This does not appear to be a major issue of contention, but over other issues. And so when will the Green Bond Standard come out? Probably, I would have hoped at the second half of this year, but it's hard to say. It may even come just before the end of the Swedish presidency in June, if the Swedes are able to kind of crack the whip. We'll see. But never. So here's the new timeline. As you can see, last year we were thinking of the passage of the EU Green Bond Standard in the second half of 2022. That was wildly optimistic, and that also means the securitization technical standards that will have to come out after that will, of course, be delayed. They can only come out after the EU GBS has been passed. So you're looking at 2024, I think, at the earliest, to get the technical standards needed. So last year we said the UK was behind because it didn't have a green taxonomy. No decisions had been made about UK GBS idea. Where did that go? Well, this is the London December 14 Reuters publication. Britain on Wednesday opposed its taxonomy for guiding companies and investors in green investments, saying it was important to consider matters carefully before finalizing its approach. Maybe that should have been advice given to Liz Truss, that considering matters carefully before finalizing an approach is not a bad approach. What this basically tells you is, this is, as anybody who's worked in a corporation knows, this is what you say when you haven't done your homework. We've decided that we should really consider this carefully. Obviously, the mind of the British government, if one can describe such a thing, was somewhat otherwise occupied in 2022, and the creation of taxonomy, and therefore UK Green Bond Standard, and therefore UK Securitization Green Bond Standard has just been pushed into some time in the future. We'll see when it comes out. So that really, nothing has happened in 2022. The timeline is now, who knows? So next topic, after the Green Bond Standards, the securitization review. This is very simple. It looked like when we did this last time that nothing much was to be expected from the review of the securitization regulation that the European Commission had to do. And basically that's exactly right. Not very little happened. Very underwhelming result. No serious changes proposed. The only two major takeaways, or maybe the only two takeaways, first is that a Europe first approach. The Commission rejected the idea of equivalence for any non-Europeans, including the UK, of course. and insisted that all the European rules would have to be applied to all non-EU securitizations sold to EU investors. So basically, we can argue, and we don't have much time to argue the pros and cons of this, but basically a Europe-first approach and maybe some help on disclosures. They put the ball in ESMA's court there. All of us would like some help on disclosures. It's a pain, especially when you have to disclose things that nobody cares about. But none of this is really going to move the dial in terms of the securitization market. So the review of securitization, as we thought it would, turned out to be much of a non-event. Okay, so this is what we said last year. At the time, the UK had not decided what it wanted to do when it grew up in terms of UK regulation. It wasn't clear whether they wanted to be close to Europe and follow Europe to a large extent, or whether they were going to basically go their own way. Now, these issues have in 2022 been resolved, I think, quite clearly. So as it says in red, the government has now made those key post-Brexit strategic decisions. And basically, what they have said is that they will go it alone. It's quite clear that their hope that somehow Europe would give them a friendly neighbor pass to have access to the European market has gone nowhere. Europe has absolutely no desire to give a special deal to the UK, having seen them slam the door behind them. So the UK has now decided it's going to do its own thing. And it's also done, in doing that, is reverted to an old English-British approach, which is that it has devolved an enormous amount of rule-making powers to the regulators. In our case, it means the PRA and the FCA. So things that appear in primary legislation in Europe will now basically be determined by the PRA and the FCA on their own. And the other thing that is clear is that UK will remain open to the world. So the Europe first approach that we saw when it came to securitization, but also a whole variety of other issues in finance, that Europe first approach is not being adopted by the UK. The UK will remain open. Now, important note, the government's deregulatory aspirations may not be aligned with its chosen tools. What do we mean by that? Well, the British government has said, we are going to do our own thing, but it's also said that that thing, whatever that thing is, we're going to let the PRA and the FCA decide. UK government has also said, this means, of course, that we can be much more open, much more deregulated, much more like a Singapore kind of situation. And some of us have skepticism here because the PRA and the FCA are not particularly good, fast draw, loose regulators. They're very conservative by and large. So whether the government's professed idea that we can move to a much more deregulated environment, when you're putting that decision in the hands of the FCA, PRA may not come to pass. They may find that PRA and the FCA, rather than deregulate, want to re-regulate or regulate harsher. So what does that mean for securitization? Well, there is this draft statutory instrument. You can see it. You can find it on our website that sets out what the future of securitization from a regulatory point of view is going to be in the UK. And in line with this general approach, the government is basically, if that draft statutory instrument becomes law, handing over a huge number of things to the FCA, including STS. So it's retained entirely in the draft STS regime, pretty much unchanged, except that the draft has no STS criteria. The 103 criteria of STS are not available at all. And they're now being delegated to the FCA. So the criteria will be decided by the FCA. The UK, as I said, rejected the EU's extraterritorial imposition. But now that we have to look to the FCA and the PRA when it comes to capital for our rules, the reality is that we don't know what's going to happen. We don't really understand what the FCA and the PRA's views on stronger, weaker regulation will be. But for example, I know people thinking, well, STS for synthetics was never part of British law because it was passed after Brexit exit. What about STS for synthetics? Well, we think they're a good thing, but we know the PRA has never been very keen on synthetics. And so whether or not, as I said, the HMG's idea that we can deregulate and make it much more flexible, and we'll ask the PRA to do that. When you look at STS for synthetics, I don't know whether or not that's going to come to pass. And finally, I realize we've only got 10 seconds, so I'll ask for your forbearance and give us a few more minutes. Don't log out. Calibration issues. Calibration issues, of course, are the calibrations for the CRR, banks holding securitizations, and the infamous P factor, the eligibility criteria for inclusion in bank liquidity facilities for the LCR, and the calibrations for STS for insurance investors in Solvency II. So there, the bad news is the ESA's reports came out and was, pretty much a disaster. EIOPA decided that everything is for the best and the best of all worlds. Nothing needed to be done. The only proposal by the EBA is to reduce the floor for senior STS tranches to 7% from 10%, which is not only de minimis, but is also meaningless, because that reduction will have no meaning as of January 2025, when the Basel III output floors come in place, because nobody's going to be even near the floors. So it's really a tiny gift, the vanishing value of which will fall to zero in January of 2025. And on LCR, they've said, well, yeah, it's a good idea. Maybe we should revisit LCR, but we really need to go to Basel. And going to Basel is basically the elephant's graveyard of any changes for STS. We're not for securitization. We're not going to see anything come out of Basel for many, many years, if anything. So that is the bad news. The good news is that the Commission, I think, genuinely wants the securitization market to come back. As a result, we think that they don't have to accept the ESA's reports. And I think there is some desire to do something. It's unhelpful that the ESAs have come out where they've come out, but, The other piece of good news, and unexpected good news, is that the European Parliament has chosen to ignore the Commission's separate securitization process. So the Commission basically said to the Parliament, there's a review of CRR, there's a review of Solvency II, but we don't want to deal with securitization in the current review, which is a massive monster review. 2,000 amendments in CRR alone. Let's deal with securitization as a separate process based on the report for the ESAs. And Parliament's basically ignored that. There's an amendment to CRR currently that will halve the P factor. There's an amendment in Solvency II, if it goes through, from the Parliament saying that the EIOPA has to reopen the calibrations for STS. So parliamentarians and Parliament generally has basically said, we're not going to follow the process that the Commission has put down. We're going to do our own thing. And therefore, we now have two processes which are in parallel, which are amendments within the current CRR Solvency II revision process and the process which the Commission has set in place, which is supposed to take place after the reviews of CRR and Solvency II. So what does that mean? That means we don't know. We don't, after the fact that there's good news and bad news, the fact that the process, they now appear to be two processes rather than one process, means the timeline is now confused. The means, if any, of obtaining improvements in CRR calibrations, Solvency II calibrations, are now confused. Which one is going to win in terms of which is the process that will deliver anything, if anything is delivered, is now confused. And so 2023 is very much a watch this space. It's very uncertain to where we are actually going to go. I think it's a 50-50 chance that we'll get something positive in 2023, certainly on the P factor. I think LCR is going to be much harder, much harder. And Solvency II is harder, although it's more important. One thing to bear in mind, of course, is that there's a bit of a race against the clock. It's a convention that the Commission does not bind its successor by any major proposals in this last year. And therefore, anything new and bold has to come before April or May of this year, because otherwise we will be in the last year of the Commission. So we are also this process is also running against the clock, although, to be fair, not the CRR and Solvency II reviews, which are already ongoing, that it doesn't bash against that clock that binds the Commission. So watch this space. We don't know. Still evolving. Hopefully, there may be some good results coming out of 2023. Maybe not. And if we don't get those good results in 2023, then because of the last year of the Commission, the last year of the Parliament, the time it takes to make any changes, I'm afraid then that we will be looking at 2-3 years to get the changes we need. So it is a bit of a make or break there for the securitization market. And with that, I mean, I've got some timelines. UK, nobody knows what's going on. We're not hearing on the calibration issues. We're hearing pretty much nothing. And so this is the last slide, the very quick slide. First, calibration issues, I've discussed them. 50-50 chance of something happening. If it doesn't happen, it's going to be a long time. ECB reduction of its balance sheet is probably going to generate more issuance, but not quite as much as people can expect if they are very optimistic. And the Basel III implementations will continue to drive capital trades, particularly in the synthetic format. That's going to continue and increase in 2023 and beyond. And with that, thank you very much for your forbearance. I noticed that we only lost 7 people after we passed the deadline of 45 minutes. This is why you should download our handout now or from our website. This is basically the new Quo Vadis Revisited, new deadlines. As not unexpected, things have shifted further into the future. It can be fun to compare this with last year's, but there's some good news. There's also some wait and see, as there always is, and that's it. So because we've overshot, I'm not sure
we have one
we will
couple
have
of
time
questions.
to take.
I'm not sure whether you want to take one.
Well, listen, I'll take the questions. If people want to bail out, obviously it's their prerogative. I will take the questions and go on. If people want to hear the answers,
or should I read them for you? Yes. Do you have any clear ideas from the Parliament about the amendments they're open to discuss about? That's from Ivan.
In a way, that's a very easy answer. No, these debates are private. Also, what makes it a bit complicated is that these questions are being asked in the context of huge reviews. As I said, in the parliamentary text, there were 2,000 amendments to CRR. And therefore, there are so many balls in the air. And securitization is not a primary concern for the big players. It's important, but it's not a primary concern. So as a result, it's very difficult to predict when all the things align where securitization will be or when it will be. So, and again, as with the European Green Bond Standard, you may find that it takes much longer for reasons that have nothing to do with securitization. The big battles on the European Green Bond Standard are not taking place over securitization. But until those battles are sorted out, there won't be an EU GBS, and that means there won't be an EU GBS for securitization. So the answer is, do I have a clear view? Absolutely.
One last question. Do you expect that direct attribution exposure to the green assets will become a selling point for the securitization product in the future, particularly in a macro recessionary environment? Proceeds are nice, assuming you are producing them.
Again, the jury's out here, and there are 2 things that will need to be considered. First of all, when does the EU Green Bond Standard come in, and whether it is made mandatory or not? One of the discussions on the EU Green Bond Standard is whether or not it should be a mandatory standard. And what I mean by a mandatory standard is anything claiming to be green in Europe will need to meet the European Green Bond Standard, and therefore will need to meet the European Union taxonomy. If it does become mandatory, it's much likelier to bite, and therefore the green proceeds approach is much likelier to win out, because it means if you're a green fund, you're going to claim to be green, you're going to be told you have to be green because you've got green assets meeting the EU Green Bond Standard, and that's a proceeds based. So I can't tell you what the answer is, but I can tell you the things that the answer will depend on, which is how quickly the green bond standard gets through, and what are the terms of the green bond standard in terms of being mandatory. The same for the green asset ratio for banks. The other thing, of course, is what investors do, and the issue of what is green and greenwashing concerns is huge. So, will green investors go for double green? It has to be proceeds and assets. I don't know. You're going to need to ask the investors. I don't think they know yet. This is a very, very lively debate. We've all seen what's happening in the US. We've all seen concerns about greenwashing here. And it's a very much a moving target at this stage. Clearly, if you can say our assets are green and our proceeds are green, the double green approach, it's belt and braces. But then you've got nothing to buy. I mean, there's going to be 4 or 5 issuers a year that do that. So again, I'm afraid I don't have a good answer for you, but I can tell you what the answer will turn on.
Okay. And with that, I don't think we have any other questions, unless anybody wants to raise anything. Okay, one more question. Do you see any change that there will be any chance there will be an adjustment to the output floor for securitizations? What do you expect in terms of impact to the market?
The problem is that the political winds being what they are, if there is an adjustment to the output floor securitization, it will be to make them worse. I see for the moment, first of all, the output floors are hugely debated. They are the subject of much, much tension between various players within the European space. I'd be skeptical, the idea that they would give special output floors for securitizations that are better than as I said, I can see people saying they should be worse, but seeing better, I doubt it. The impact of output floors on securitizations will depend on whether or not we get a P factor calibration. Because currently the output floors are devastating because the SEC calculations produce horrendous and inaccurate results. So if we don't get an improvement in the P factor, then the output floors could be very, very punitive for securitizations, especially because they're such good products that the internal models produce very small capital requirements. In fact, they pretty much hit the floor every
if we may add, the P factor also impacts the risk weights on the lower rated tranches. So the P factor, you have to change the formula. The knock-on effect of every change is not going to affect another stuff. So the combined, I think if you start with what I consider a very complicated formula, anytime you twist or touch it, something comes out of it that is an undesired effect, and that's one of the undesired effects, I think.
Yeah. But certainly no change to the P factor is very bad news for securitizations if the output floors come out the way they're structured today. And modification, there won't be a modification of the output floor for securitization. I'd be very, very surprised. But what we are hoping for is a modification of the calibration, which means that the output floors are less punitive for securitizations because the SEC calculations give you a more realistic and lower capital requirement. Okay. And with this, we've almost got an hour on a 45 minutes presentation. I'm gratified to see there's still 106 people on the call. But I think with this, again, anybody has questions, just send us an email to me or to Harry, and we will do our very best to come back to you and give you a satisfactory answer. With that, thank you very much for joining us. Join us next year. I think this will probably become a yearly feature. You can watch securitization, evolve over time, hopefully in the right direction. And with that, have a nice day. Thanks.